Look, I need to show you something that's happening right now to retirement accounts across America. And I'm not talking about market volatility or some temporary dip. I'm talking about a systematic erosion of purchasing power that's accelerating faster than most people realize. Here's what I mean. Let's say you've got $500,000 sitting in your IRA right now. Sounds like a solid nest egg, right? But here's the problem. That number on your statement, it's not telling you the whole story. Because while that balance might look the same month after month, what that money can actually buy is shrinking at a rate we haven't seen in over 4 decades. The official inflation numbers tell us one thing. But when you actually go to the grocery store, when you pay your insurance premiums, when you look at healthcare costs, you know the real story. And it's not matching up with what the government's telling us. Now, I want to walk you through exactly what's happening behind the scenes, because there's a reason why some of the smartest money in the world is making a very specific move right now, and it's not what you'd expect. Let's start with what central banks are doing. Not what they're saying, what they're actually doing. In the past 18 months, central banks globally have purchased more gold than at any point since they went off the gold standard. We're talking about institutions that have access to every piece of economic data, every projection, every insider briefing, and they're converting their reserves into physical metal at a pace that's frankly unprecedented. The People's Bank of China has been adding to their gold reserves for 17 consecutive months. Not stocks, not bonds, not even their own currency. Gold. The National Bank of Poland just moved 20% of their entire reserve into gold. Turkey's central bank has tripled their gold holdings. These aren't small players making emotional decisions. These are sophisticated institutions with teams of economists who see something coming. But here's where it gets interesting. While central banks are buying, there's a massive disconnect happening in the paper markets. The COMEX, that's where gold futures trade, is showing something really unusual. The ratio of paper claims to actual physical gold has blown out to levels we've only seen twice before. Once in 2008, right before the financial crisis, and once in 2011, right before gold hit its previous all-time high. What does that mean in plain English? It means there are way more people holding contracts that say they own gold than there is actual gold to deliver. It's like a game of musical chairs, except when the music stops, most people are going to find out they're holding a piece of paper, not actual metal. Now let me tell you about something that happened recently that didn't make mainstream news. A major European bank, and I'm talking about one of the big ones, tried to take delivery of physical gold from the LBMA in London. That's the London Bullion Market Association, basically the Fort Knox of the private sector. They were told there would be a 6-week delay. 6 weeks. For an institution that's supposed to have immediate access to their allocated gold, that's not normal. That's a red flag the size of Texas. And it's not just happening in London. The premiums on physical gold, that's the markup you pay over the spot price to actually get your hands on real metal, have been climbing steadily. In some markets, you're paying 8 to 10% over spot just to get physical delivery. That spread tells you something. It tells you there's a shortage developing between what the paper market says gold is worth and what people are willing to pay to actually own it. Let's talk about what this means for your retirement account. Most IRAs are sitting in a mix of stocks and bonds, right? Maybe some mutual funds, some index funds, and on paper, those might be holding their value or even going up. But here's the critical question nobody's asking. What happens to those assets when the dollar itself is losing purchasing power? Because that's what's really happening. The dollar is being systematically devalued, not through some conspiracy or secret plan. It's happening right out in the open through monetary policy. Every time the Federal Reserve expands the money supply, every time the government runs a massive deficit, every time they print money to cover obligations, your dollars become worth less. Think about it this way. Back in 1971, when Nixon took us off the gold standard, an ounce of gold cost $35. Today, it's trading above $2,600. Did gold become more valuable, or did the dollar become less valuable? Gold is the same metal it's always been. It's the measuring stick that changed. And here's what keeps me up at night. The pace of dollar devaluation is accelerating. We've added more to the national debt in the past 4 years than in the entire history of the country before that. The interest payments alone on our national debt now exceed our entire defense budget. Let that sink in. We're paying more just to service our debt than we spend on the entire military. That's not sustainable. And the people who understand monetary systems know it's not sustainable. That's why they're moving into hard assets. Now, I want to tell you about something that most people don't realize is even possible. You can actually hold physical gold inside your IRA, not a gold ETF, not a mining stock, not some paper derivative. Actual physical gold that's allocated to you, stored in a secure vault, but still inside your retirement account with all the same tax advantages. I put together a comprehensive guide on exactly how this works. It covers the IRS rules, the custodian requirements, how to roll over existing retirement funds without triggering taxes or penalties. If you've got $100,000 or more in retirement accounts, this is worth understanding. The guide's completely free. You'll find it in the description below. No obligation, just information you should have. But let me get back to why this matters right now. There's a concept in economics called the Cantillon effect. It's named after an Irish-French economist from the 1700s, but it's more relevant today than ever. Here's what it means. When new money enters the system, it doesn't affect everyone equally. The people closest to the money printer benefit first. By the time that money trickles down to regular people, prices have already adjusted upward. So the wealthy, the connected, the institutions, they get to spend the new money at yesterday's prices. By the time it reaches your paycheck or your retirement account, you're paying tomorrow's prices with yesterday's dollars. You're always one step behind. That's why you see this massive wealth gap expanding. It's not just about income inequality, it's about monetary inequality. The people who understand how the system works are converting their paper wealth into hard assets before the devaluation catches up. The people who don't understand it are watching their purchasing power evaporate while their account balance stays the same. Let me give you a concrete example. Let's say you retired in the year 2000 with $1 million in your IRA. Sounds like you're set for life, right? But let's look at what that $1 million could actually buy. In 2000, the median home price in America was $165,000. Your $1 million could buy 6 houses. Today, the median home price is over $400,000. That same $1 million, if it just sat in cash or low-yield bonds, now buys you 2.5 houses. You lost more than half your purchasing power, even though your account balance might look similar. But here's the kicker. If you had converted just 20% of that IRA into gold back in 2000, when gold was trading at $280 an ounce, that portion would now be worth nearly 10 times what you paid. That $200,000 in gold would be worth close to $2 million today. It would have more than made up for the purchasing power you lost on the rest of your portfolio. I'm not saying this to make you feel bad if you didn't do that. I'm showing you this because the same dynamic is playing out right now. We're at another inflection point, and the people who recognize it are taking action. Look at what's happening in the physical gold market right now. The U.S. Mint can't keep up with demand for American Eagle coins. They've had to ration supply to their authorized dealers. That's never a good sign. When the government mint can't produce enough coins to meet demand, it tells you something about what regular people are figuring out. And it's not just retail buyers. Look at the ETF flows. The big gold ETFs like GLD and IAU have seen massive inflows recently. But here's what's interesting. The premiums on those ETFs are starting to diverge from the spot price of gold. That means people are willing to pay more than the actual gold is worth just to get exposure. Why? Because they can't get their hands on physical metal fast enough. There's a supply crunch developing. And it's not because we're running out of gold. It's because the gold that exists is increasingly being held by people who don't want to sell. Central banks aren't selling. Sovereign wealth funds aren't selling. High net worth individuals who've moved into gold aren't selling. They're holding. And when you've got strong demand meeting tight supply, there's only one direction for price to go. But here's what most people miss. The price of gold going up isn't really about gold becoming more valuable. It's about the dollar becoming less valuable. Gold is just the mirror that reflects the dollar's true purchasing power. When you see gold hitting new all-time highs, what you're really seeing is the dollar hitting new all-time lows in terms of real purchasing power. Now, let me tell you about something that happened in the 1970s, because we've seen this movie before. In 1971, Nixon closed the gold window. Suddenly, the dollar wasn't backed by anything except faith in the government. And what happened? Inflation exploded. By 1980, inflation hit 14%. People's savings were being destroyed in real time. But here's what's fascinating. If you look at gold during that period, it went from $35 an ounce to $850 an ounce. That's a 24x increase in less than a decade. The people who recognized what was happening and moved into gold didn't just preserve their wealth, they multiplied it. And then what happened? Paul Volcker came in as Fed chairman and jacked interest rates up to 20%. He broke the back of inflation, but it caused a massive recession. Gold crashed back down, and for the next 20 years, Gold was in a bear market. But here's the difference between then and now. Back then, the national debt was manageable. The government could afford to raise interest rates that high because the debt service was relatively small. Today, we've got $34 trillion in debt. Every 1% increase in interest rates costs us $340 billion in additional interest payments. We literally cannot afford to raise rates the way Volcker did. So what's the alternative? There isn't one. The Fed is trapped. They can either let inflation run hot and destroy the dollar's purchasing power, or they can raise rates and bankrupt the government. Those are the only two options. And neither one is good for people holding dollar-denominated assets. That's why gold is different this time. In the 70s, gold was a trade. You could get in, make your money, and get out. Today, gold is becoming a permanent allocation because the structural problems in our monetary system aren't going away. They're getting worse. Let me show you something else that's happening. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And they're backing their currencies with gold. Now, I'm not saying the dollar is going to collapse tomorrow. That's not how these things work. But what I am saying is that the dollar's dominance is being challenged in a way it hasn't been since World War II. And when you're the reserve currency, you have a massive advantage. You can print money and export your inflation to the rest of the world. But when you lose that status, all that inflation comes home. Think about what that means for your retirement account. If the dollar loses even a portion of its reserve currency status, the purchasing power of dollar-denominated assets is going to take a hit, and it's not going to be a small hit. We're talking about a fundamental repricing of everything denominated in dollars. The smart money sees this coming. That's why they're diversifying out of pure dollar exposure. They're moving into assets that hold value regardless of what happens to any particular currency. And gold has been that asset for 5,000 years. Here's something most financial advisors won't tell you. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was designed for a different era. It was designed for a time when bonds actually paid a real yield above inflation, when the dollar was stable, when government debt was manageable. That world doesn't exist anymore. Bonds are paying negative real yields after inflation. The dollar is being systematically devalued. Government debt is spiraling out of control. The old playbook doesn't work in this environment. But there's a new playbook emerging, and it includes a significant allocation to hard assets, not as a speculation, not as a trade, as a core holding to preserve purchasing power. Let me tell you about a conversation I had recently with a wealth manager who handles portfolios for ultra-high net worth families. These are people with $50 million, $100 million, $500 million in assets. And he told me something fascinating. He said 5 years ago, if he suggested a 10% allocation to gold, his clients would have looked at him like he was crazy. Today, his clients are asking him why they're not at 20 or 30%. What changed? These people have access to the best information, the best advisors, the best research, and they're seeing the same thing the central banks are seeing. They're seeing the writing on the wall. Now, I want to be clear about something. I'm not telling you to panic. I'm not telling you to liquidate everything and buy gold bars. What I'm telling you is that you need to understand what's happening to the purchasing power of your retirement savings, and you need to have a strategy to protect it. For most people, that means having some portion of your retirement assets in something that can't be printed, can't be devalued, and has held value for thousands of years. It means having a hedge against the systematic devaluation of the dollar. And the beautiful thing is you can do this inside your existing retirement accounts. You don't have to take a taxable distribution. You don't have to pay penalties. You can roll over funds from a 401k or an existing IRA into a self-directed IRA that holds physical gold. The gold is stored in an IRS-approved depository, allocated specifically to you, and you maintain all the same tax advantages. The guide I mentioned earlier walks through exactly how this works. It covers the custodian requirements, the storage options, the IRS rules you need to follow. If you're sitting on 6 figures or more in retirement accounts, this is information you need to have. Again, it's in the description. Completely free, no strings attached. But let me get back to the bigger picture, because there's something else happening that most people aren't paying attention to. The velocity of money is starting to pick up. That's a fancy way of saying money is changing hands faster. And when that happens, inflation accelerates. For the past few years, All the money the Fed printed just sat in the banking system. It didn't circulate through the real economy. That's why we didn't see massive inflation immediately. But now, that money is starting to move. It's entering the real economy. And when it does, prices are going to adjust. We're already seeing it in certain sectors. Real estate, healthcare, education, food, energy. These aren't small, temporary increases. These are structural shifts in price levels. And once prices reset higher, they don't come back down. That's not how inflation works. So what do? You position yourself ahead of the curve. You move some of your wealth into assets that benefit from inflation rather than being destroyed by it. Gold is the obvious choice because it's been the inflation hedge for all of human history. But there are other hard assets too. Real estate, commodities, productive assets that generate real cash flow. The key is to stop thinking in nominal terms and start thinking in real terms. Your account balance doesn't matter. What matters is what that balance can buy. And if what it can buy is shrinking every year, you're not preserving wealth. You're losing it in slow motion. Here's the thing that frustrates me. Most people don't realize this is happening until it's too late. They look at their statement, see the balance is roughly the same or maybe up a little, and they think they're fine. But they're not fine. They're falling behind. And the gap between where they are and where they need to be is widening every single day. I don't want that to be you. I don't want you to wake up in 5 years or 10 years and realize that your retirement savings have lost half their purchasing power while you were sleeping. Because by then, it's too late to do anything about it. The time to act is when you still have options, when you can make strategic moves to protect yourself, when you can position your portfolio to weather what's coming instead of being blindsided by it. And look, I get it. This stuff is uncomfortable to think about. It's easier to just assume everything will work out, that the government will figure it out, that the Fed knows what they're doing, that your financial advisor has your back. But the reality is, the government is the one creating this problem. The Fed is trapped by their own policies, and most financial advisors are working with an outdated playbook that doesn't account for the monetary environment we're actually in. You have to take responsibility for your own financial future. You have to educate yourself. You have to understand what's really happening, not what you're being told is happening. And what's really happening is a massive transfer of wealth from people who hold paper assets to people who hold hard assets, from people who trust the system to people who understand the system, from people who wait and hope to people who act and prepare. Which side of that transfer do you want to be on? Because here's the truth. The purchasing power of your IRA is bleeding out right now. Every day that goes by, every dollar that gets printed, every deficit that gets run up, it's eroding the real value of your retirement savings. And if you don't do something to stop the bleed, you're going to wake up one day and realize it's too late. But it's not too late yet. You still have time. You still have options. You can still protect yourself. The question is, will you?